Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in today's video, we'll be taking a look at the Teladoc and Livongo merger, breaking down the numbers to try and figure out if the move is actually beneficial for investors. Just a friendly reminder to hit the like button at the end if you enjoyed the video, but also the subscribe button if you're new, as it really helps support the channel as we continue to push for that elusive 1000 subscriber. So with all that said, let's dive right in. On August 5th, it was announced that two of the fastest growing companies and also best performing stocks of 2020, namely Teladoc Health, ticker symbol Tango Delta Oscar Charlie, and Livongo Health, ticker symbol Lima Victor Golf Oscar, had agreed to an amalgamation to form what should be the largest e-health provider in the world. Upon completion of the merger, the combined company will be branded simply as Teladoc Health, but ownership will in fact be divided, with the existing Teladoc shareholders entitled to approximately 58% of the combined entity and Livongo shareholders entitled to approximately 42%. Since the deal won't officially be finalized until sometime in Q4, pending the usual legal, SEC, and antitrust clearance procedures, the exact valuation of the deal isn't yet known for certain, but by examining the details under the lens of the August 4th closing prices, we can at least attempt to understand the size and scale. As such, let's take a look at the projected numbers and then move on to what this might mean for current investors in either company, but also potential investors looking in from the outside. So, under the terms of the agreement, each share of Livongo will be exchanged for 0.592 shares of Teladoc plus a cash consideration of $11.33. To illustrate what this means using an example, if you were to own 1,000 shares of Livongo on the eve before the deal is official, on the next trading day, you would be required to give up all those shares, but in turn, be awarded 592 shares of Teladoc plus an extra $11,330 in cash. Obviously, for holdings of less or more than 1,000 shares, the numbers will scale accordingly, with any odd number which cannot be converted into whole shares being paid out completely in cash. Now, using the aforementioned August 4th pricing, if we multiplied Teladoc's stock price of $249.42 by 0.592, and after adding the $11.33 cash component, we arrive at a final price of $158.88 per share. When compared to Livongo's price of $144.53, this conveys to existing investors a premium of just under 10%. Initially, the merger seemed like a horrible deal for all parties involved. Teladoc paid an extremely hefty price tag for Livongo, an amount that was at the time of the announcement valued at upwards of $18.5 billion to merge with a company that only went public a year ago and generated a relatively meager $170 million in revenue. For Livongo investors, the 10% premium was viewed as much too little, considering the stock had increased roughly 500% off the March lows as a solo act, and seeing as how the company will now be incorporated into a larger entity, likely means it will lose its hypergrowth status moving forward. The negative sentiment on the market has been palpable, and the stock prices of both companies have clearly taken a hit, but an important consideration not to be overlooked is the fact that the delta between the stock prices has fluctuated in the past week or so since the announcement, and will likely continue doing so. This could very well play a significant factor if prices for either of the companies cannot regain the level from the August 4th all-time highs, as the deal could result in an even smaller premium for Livongo investors than the announced figures. In fact, even the sterling Q2 earnings report from Livongo, who reported a customer base increase of 113% year over year and a staggering 125% increase in revenues year over year to $91.9 million for the quarter, compared to analyst expectations of around $87 million, was not enough to stop the bleeding. Usually one expects the stock to skyrocket after hours upon such a significant earnings beat, but the market had soured so much on Livongo as a result of the merger that it actually went the other direction. When the companies began discussing terms in what must have started weeks if not months ago, it was unlikely that Livongo insiders could have foreseen the incredible 500% price increase and skyrocketing market cap since March, and so a 42% stake in the larger Teladoc would have been an appealing concept. But a legitimate question today, given the huge shift in prices, is to wonder if management from either side of the fence are actually acting in the best interests for all investors. Let's actually first take a quick look at each company's existing business models and then move onwards to how there might be potential synergy that could ultimately reward all parties. First off, Livongo Health. At its core, it is both a health services provider, but also a cloud computing company which leverages data science and connected devices. It has built a unique system called Applied Health Signals, which monitors and tracks blood sugar, blood pressure, and a patient's weight, and funnels all of the data into an artificial intelligence engine, which then analyzes it. The engine also combines the health metrics with a multitude of data points, such as weather forecasts and the locations of nearby facilities, such as gyms and pharmacies, to create a tailored, personable, and actionable health maintenance plan. Even social factors of health, like commute times, where users shop for groceries, and how often they go for walks, can all be integrated by the platform. Each time a health signal is delivered, the engine collates the new data and is able to iterate to further personalize future interactions. The ultimate goal of the system is to provide one-on-one coaching of patients to manage health chronic conditions, primarily diabetes and hypertension, and gently nudge users to take the necessary precautions or actions in order to live in a healthy and sustainable manner. According to Livongo, there are almost 150 million Americans with at least one chronic health condition, and 40% of those actually have multiple, such as both obesity and diabetes. To investors, this means there is an enormous total addressable market in the US alone, especially in a country with notable healthcare system issues and inequalities, and a stay-at-home model under the current social distancing measures should only incentivize further adoption. In fact, according to Statista, the cost of global health expenditure of just treating diabetes alone could rise to as much as $845 billion by the end of 2045, a slow and steady increase from the current $760 billion. The significant growth opportunity, coupled with the company's software as a service or SaaS mode of operation, billing clients on a month-to-month basis on multi-year contracts, also means Livongo is likely to collect predictable and recurring revenue in perpetuity, a great attribute to take into consideration as an investor. Just like Livongo, Teladoc is a trailblazer in the e-health space. It is a first mover in the virtual healthcare segment, having gone public 5 years ago, and is by far the largest, with 51.5 million paid members as of Q2 2020, and a network of over 50,000 physicians providing non-emergency consultation within 450 medical subspecialties, ranging from everyday care, including flu, sinus infections, and stomach aches, to mental health through counseling and even prevention, such as nutrition advice. Not to mention that it has already established a foothold globally across even parts of Europe, China, South America, and the Pacific. The company concept is quite simple. Download the app on a mobile device, register for an account, and get access to a doctor or other healthcare provider remotely, who can then provide advice or a prescription right at a user's fingertips. The app itself enables Teladoc to predominantly collect its revenue via account subscriptions, either through channel partners such as global insurers or working in combination with employers and hospitals, so similar to Livongo in a sense, but they also offer a direct-to-consumer alternative which charges per call, and this actually constitutes around 25% of their top line. The appeal is fairly straightforward for the adoption of Teladoc on all fronts. It claims that up to 92% of patient issues are resolved after the first visit, physicians can earn up to 50% more per hour than standard rates, and channel partners and even customers on average are seeing significant ROI from cheaper fees than a physical drop-in. Quickly looking at Teladoc's latest earnings report from just before the merger to get a feel for its financial standing, it reported very healthy revenue growth of 85% to $241 million, an obvious beneficiary of the pandemic, and an acceleration in total visits rising a whopping 203% to 2.8 million. Aside from the numbers themselves, the best result was just greater awareness and acceptance of virtual care as a service from the market under the pandemic. The path ahead is quite clear. Provide the masses with an alternative for cases where hospitalization is not required, whilst improving the quality of personalized care that also allows customers to dictate when and where to get treatment. The combined Teladoc and Livongo entity should enable this by creating a unified digital platform to own the entire end-to-end patient journey, from virtual physician consultation to ongoing one-on-one engagements, which empowers users to manage their conditions if they are chronic. Of course, there will be headwinds, such as the obvious administrative and technical redundancies leading to duplicated costs, but these could potentially be tackled over time as the company matures and realizes the synergistic benefits from both vectors. Teladoc's CEO Jason Gorovich even acknowledged this during a recent call with CNBC, as even before the merger was announced, he had already begun formulating plans to expand Teladoc to encompass chronic condition management, going so far as to state that the two companies were either on a path of convergence or collision. So rather than compete at the corporate level and take away value from consumers and to expend resources to undermine one another, the companies chose instead to merge and attempt to deliver an unparalleled value proposition. This was fortunate on both sides, as objectively speaking, Livongo's moat prior to the merger was certainly not as technology or product, as the company has not built anything particularly revolutionary, and its intellectual properties certainly don't compare to the leaders of other industries, such as Tesla within battery tech or Google within the search engine space, for example. But the advantage Livongo did have was that it was the first to scale commercially, which bought it time to build out a network of both clients and distributors, and iterate its AI platform with real-world data whilst competitors were still waiting to go to market. The moat was vulnerable to a player like Teladoc, with its even larger distribution network, had it decided to invest money on a competing technology or product and eventually went to market. At the same time, having focused almost exclusively on telemedicine up until this point, Teladoc was ill-equipped for hostilities, as it was well behind the pace in its ability to deliver contextually driven healthcare to help chronic sufferers due to lack of data and expertise within that particular segment, and the longer it took to go to market, the bigger the lead Livongo would be building. As we can see from this article dated way back in 2016, it had already previously decided to delay a venture into chronic condition management, and clearly 4 years on was still not quite ready with a competitor to Livongo. Meanwhile, according to the investor presentation slide deck from their merger announcement, there is only a 25% overlap in clients between the two companies, meaning 75% of the combined customer bases are still candidates to be upsold services either from Teladoc's catalog or Livongo's. With a Teladoc user base consisting of approximately 70 million with access to its platform in the US alone, and Livongo only with 410,000 members for its diabetes program, there is a potential untapped market in the millions in the long term. But even in the short term, there is clear low-hanging fruit that could be harvested almost immediately. For example, Livongo's artificial intelligence currently connects users to trained medical professionals, either employed or contracted directly by Livongo, to provide remote advice should a user require that level of medical attention or escalation, and clearly this is right into the wheelhouse of Teladoc. Conversely, if a patient calls up a Teladoc employed physician for an issue regarding diabetes or hypertension management, the doctor can quickly cross-sell and sign them up to the Applied Health Signals program. With the merger, Teladoc will also serve as a massive funnel for Livongo's programs. While Livongo was slowly expanding into the direct-to-consumer market and perhaps even considering launching internationally, this accelerates a timeline dramatically. Already possessing a footprint in over 130 countries means that Teladoc's existing network can help Livongo expand much quicker than they would have alone from scratch. Furthermore, as previously mentioned, a big part of what made Livongo an industry leader was its ability to ramp up. They were able to start with diabetes, but quickly expand to adjacent segments like hypertension, behavioral health, and weight management to become an umbrella provider for chronic condition management. Again, given the scale of Teladoc's existing distribution network of channel partners and B2B relationships, Livongo could grow exponentially and widen the gap between itself and any would-be competitors. Strategic synergies aside, I would be remiss not to mention one other critical aspect of the merger. Data in general is extremely valuable, and whoever has it yields significant leverage. If we take Google, Apple, and Facebook for example, and how much influence they have had on society. This is probably even more true in healthcare than any other industry. The combined Teladoc Health company can now augment the 70 million patient records in its database with real-time chronic health data to build the most comprehensive and complete profile of a user possible. The ability to triage or refer medical services based on need would be unmatched, as doctors can monitor their patient's progress and prescribe medication as necessary, but even have the ability to push advice or notifications to their patients in-app and adjust their treatment as necessary. This would be a much more efficient allocation of a health provider's resources, but also patients' resources, and reduces the overall burden on the healthcare system and its insurers. When it is all said and done, this could become an impenetrable ecosystem similar to what tech giants like Apple have built, for example, and could exclude other players or systems, which will in turn force hospitals to cooperate with them rather than try to shut them out. If and when it is able to put all the pieces together, instead of Teladoc and Livongo competing against one another or other startups, the combined entity will instead have its eyes on the 90% spend within the $3.5 trillion US healthcare system and eventually expand internationally to countless trillions abroad. In terms of financials, the combined Teladoc Health company will have $1.3 billion pro forma revenue in 2020, up 85% year over year, which is really an aggregate of both Livongo and Teladoc. It also expects more than $500 million of revenue synergies by 2025, meaning revenue from cross-sales, referrals, and combined business opportunities, leveraging the customer cross-section not currently within the 25% overlap. Not to be overlooked are also the organic reduction in costs created by the merger, already $60 million by the end of 2022. Looking at the trailing 12 months, gross margins came in at 67%, which is, as we will see on the next image, is projected to increase 2 to 3% annually. Since neither company has yet to achieve profitability, an increase in combined gross margin is clearly crucial to achieving this eventual target. Cash and equivalents, which comprise current assets, run lower than overall debt, which is generally a concern for most companies, but seeing as how $1.3 billion was used to fund aspects of the merger, at least there is a reasonable explanation and is just a one-time cost. Hopefully this won't be an issue moving forward and the company will be able to get above a 1-to-1 ratio again in the near future, but it is still something to consider. As standalone companies, analysts were projecting Teladoc to grow between 30 to 40% in 2021, while Livongo consensus estimates projected around a 55% growth. As a combined company, the projections will obviously land somewhere closer to the middle, so investors can expect a 30 to 40% compound annual growth rate pre-synergy over the next few years. While this is clearly not as lofty as Livongo's pre-merger growth rate, their annual returns could still be quite substantial if the company can realize synergistic benefits sooner rather than later and add to this figure. Finally, TDOC is currently trading at a roughly 21 times price to sales ratio, but if we factor in the revenues of Livongo and the 30 to 40% revenue growth in 2021, which is less than 6 months away, the price to sales ratio is looking a lot more reasonable and closer to 15 according to calculations. So new investors looking to buy Teladoc shares should take note of this, since at the current price level represents only a slight premium above the health industry average of about 9, and keeping in mind that there are very few comparable growth stories on the market trading at such a discount as an industry leader or pioneer growing unchallenged in its own segment. The ascension of both Teladoc and Livongo individually during the pandemic has proven to investors that e-health and digitalization is not just a pipe dream, and the 1-2 punch years from now could ultimately show that the new Teladoc Health not only gives consumers a viable choice, but also empowers them with an alternative to traditional brick and mortar solutions. This has all the makings of a monopoly that could dominate the healthcare industry for years to come. That about wraps it up for this video. What are your thoughts on the merger, and if you are either a Teladoc or Livongo investor, have you become more or less bullish? Post them down below in addition to any other questions or comments. Also, don't forget to hit the like button if you enjoyed this video, and again, please consider subscribing to really support the channel if you haven't done so. Before I go, click on the top video here to take a look at a breakdown of the Q2 results from the data science software company Alteryx, or alternatively, down here for a look at Lemonade, a company using artificial intelligence to disrupt the age-old insurance industry. As always, thanks for watching, and I'll see you in the next one.